C. Manage issuance of debt and equity, including issuance, post-issuance compliance, dividends and retirement. Managing the issuance of debt and equity is a major treasury responsibility because organizations rely on capital markets to finance growth, acquisitions, operations, and long-term strategic initiatives. Treasury professionals evaluate financing alternatives based on cost of capital, market conditions, organizational risk tolerance, and shareholder expectations. Debt financing may include bonds, notes, commercial paper, or bank loans, while equity financing involves issuing common or preferred shares to investors. Treasury teams analyze leverage impacts, earnings implications, investor demand, and liquidity requirements before selecting an appropriate financing structure. Effective capital raising supports organizational expansion while balancing financial flexibility and risk exposure. Treasury professionals coordinate with investment banks, legal advisors, accountants, rating agencies, and regulators throughout the issuance process to ensure successful execution and compliance. Debt issuance involves raising borrowed capital through structured agreements that require periodic interest payments and eventual repayment of principal. Treasury professionals negotiate financing terms including coupon rates, maturities, repayment schedules, covenants, and security provisions to minimize borrowing costs while maintaining operational flexibility. Organizations may issue fixed-rate or floating-rate debt depending on interest rate expectations and risk management strategies. Treasury professionals also evaluate credit ratings because stronger ratings reduce borrowing costs and improve market access. Equity issuance, in contrast, raises permanent capital without mandatory repayment obligations but may dilute existing shareholder ownership. Treasury teams assess market valuation, investor sentiment, dividend expectations, and capital structure objectives when considering equity offerings. Proper financing decisions support liquidity management and long-term financial sustainability. Post-issuance compliance is an ongoing treasury responsibility that ensures organizations meet contractual obligations, regulatory requirements, and investor expectations after capital has been raised. Treasury professionals monitor debt covenant compliance, interest payment schedules, disclosure requirements, and reporting obligations associated with issued securities. Failure to comply with financing agreements can result in penalties, higher borrowing costs, reputational damage, or accelerated repayment demands. Treasury teams maintain communication with lenders, investors, rating agencies, and regulatory authorities to ensure transparency and preserve market confidence. Treasury management systems support compliance monitoring by tracking debt balances, maturity schedules, covenant calculations, and payment obligations. Strong governance processes and internal controls are essential for maintaining accurate reporting and reducing operational or legal risks associated with capital market activities. Dividend management and capital retirement activities are important aspects of equity administration and capital structure management. Treasury professionals evaluate dividend policies based on profitability, cash flow availability, shareholder expectations, and future investment opportunities. Dividend decisions affect investor confidence, market perception, and retained earnings levels. Organizations may distribute cash dividends, stock dividends, or initiate share repurchase programs to return value to shareholders. Treasury professionals also manage debt retirement activities through scheduled repayments, refinancing, bond repurchases, or early redemption strategies. These decisions require analysis of interest rate conditions, liquidity impacts, refinancing opportunities, and overall leverage objectives. Effective management of dividends and retirement activities supports capital efficiency, shareholder relations, and long-term financial stability. From a CTP examination perspective, candidates must understand the processes, risks, and strategic considerations associated with debt and equity issuance management. Exam questions frequently assess the ability to evaluate financing alternatives, analyze leverage impacts, interpret covenant requirements, and recommend capital structure strategies. Candidates should understand bond issuance procedures, equity financing considerations, dividend policies, debt retirement methods, and post-issuance compliance obligations. Knowledge of credit ratings, investor relations, market conditions, and regulatory requirements is also important for Treasury decision-making. Treasury professionals must recognize how financing decisions influence liquidity, profitability, risk exposure, and shareholder value. Mastery of these concepts enables Treasury professionals to support effective capital management and long-term organizational financial success.